Hi, good evening, everyone. Thank you for joining us in this post policy call. Uh, as you know, this was a very, very eventful policy, so we'll spend some time discussing it and what we think are market implications. So, there were actually three surprises in the uh, RBI policy today. The first was a 50 basis point repo rate cut, which was against the consensus expectation of 25 basis. One or two economists were predicting 50, but the majority was leaning towards 25. The second surprise was a 100 basis point CRR cut effective from September over 4 fortnights, so that by December, so between September and December, it will release another 2 lakh 50 odd thousand crores of liquidity into the system. And the third, which was a negative surprise, was the Monetary Policy Committee decided to change stance from accommodative to neutral. In fact, the explanation given is that most of the heavy lifting on growth that monetary policy could do has been done, and from here there will be greater data dependency. It's important to analyze each of these in turn and what they mean for the market and economy, and let's get into that. So, if you take the first two things, which is the more than expected repo rate cut and the CRR cut, they basically are consistent with the central theme that the RBI under the new governor has been driving, which is to ensure broad based transmission of rate easing into the general economy. So you'll recall that over the last few months, the RBI has been busy providing more and more liquidity to the market. In fact, so much so that market participants have been continually surprised by the extent of measures RBI has taken to provide more liquidity to the marketplace. As per our calculations, after the RBI dividend to Government of India, the so-called core system liquidity, which is headline liquidity adjusted for government cash balances, is in excess of 6 lakh crores. So, the first two actions, which is 50 base point of repo rate and the 100 base point of future CRR cut, we would see from that same prism that RBI and by extension MPC do not want any roadblocks whatsoever for broad-based transmission of the easing cycle. Now, probably it's also an iterative learning that uh, might as well get it done upfronted so that the general economy can more proactively get the benefits of the easing cycle. And so far, so good. Everything is consistent with previous RBI actions. What is more curious to us and to many in the marketplace is this change of stance from accommodative to neutral. Now, from an MPC standpoint, it is basically signaling that, look, we have been very proactive, we have upfronted our easing, and therefore you should not expect much more on the table, which is fair as it goes. But there are problems with it, and I'll just get into those problems. The first is that the stance was only changed in the April policy from neutral to accommodative, and in the June policy they have gone back from accommodative to neutral. Second is that the accommodative stance by itself means that either there is propensity to hold or propensity to cut. It does not necessarily refer to how many cuts one should expect from the MPC. And therefore, we thought, from that standpoint also, it was strange that they chose to change the stance to neutral. However, most importantly, there is an expectation channel also to transmission. So, economic agents don't just react to the current level of funding at the overnight window or, general level of funding, but they also react to the expectation on future cost of funding. Now, to us, it seemed like an unnecessary exercise at this juncture to cut off this future expectation channel of the marketplace. And one of the ways that it got very clearly evidenced in the bond market today is there was aggressive steepening of the yield curve. So depending upon which segment of the yield curve you were owning, today was either a rate cut day for you or a no rate change day for you, or for some people it was a rate hike day also. And by that I mean that 3-4 year bonds moved down by 15 to 20 basis points. The 10-year segment yields were actually up 4-5 basis points, and the 30-year segment was up even more, around 8-9 basis points. So there was, and actually 10-year was, yeah, maybe 3 to 4 basis points. So there was aggressive steepening of the yield curve, basically reflecting a market view reacting to the change in stance. And the market thinking, look, that this is pretty much the end of the rate cut cycle. Also, the future CRR cuts probably leads to a section of the market expecting that whatever OMO purchases you may have budgeted for over the back end of the financial year may not any longer happen. So that is what happened. And like I said, it's an unnecessary complication to monetary policy, which has so far been conducted fairly proactively. Now, it's also important to analyze that it's not as if the market was expecting many more rate cuts after 5.5. Our also official terminal repo rate forecast was 5.5%, which got achieved today. However, we had and continue to keep the door open for future cuts should global growth format deteriorate further. So it's not that something very material was achieved by changing stance today in terms of market expectation, because market would have said that 5.5 can go to 5 quarter maximum. The most bullish would have been at 5. However, it's almost a human tendency that if you try to firmly shut a door on something, that is taken much more adversely than the probability continuing to exist that, look, the RBI will have our back if growth were to fall further, and that remains. So I don't think the RBI themselves or the MPC themselves have firmly shut the door on further easing. It's just that by this unnecessary change in stance, they have basically lifted the threshold for market to start expecting future rate cuts. And again, to some extent, it works against the agenda of transmission, because like I said, they have probably underestimated the expectation channel that exists for economic agents, so that not only the current level of funding matters, but your expectation for future level of funding. Now, like I said, there has been aggressive steepening of the yield curve today, which reflects two things. One, like I said, is most of market participants will probably think that we are done with repo rate cuts for now. Frankly, that is what we would assess as well. But importantly, like I said, we are of the view that the global growth format is under pressure, and that over a period of time, you will probably see a lower average global growth than what is currently budgeted for, with repercussions for India as well. And that may very well open up room for further monetary policy easing from the RBI. So we continue to keep an open mind on that. The second thing is about future OMOs. So one of the things we think why RBI chose to already announce the CRR cut starting September onwards is that September onwards is when you enter the so-called busy season on credit. And maybe RBI just wanted to keep any discussion that we may have some problem on liquidity over second half put to bed, so that nothing comes in the way of transmission. And that thinking is very, very clear. However, it's not that you can firmly reject the needs for OMOs over second half, although yes, the need for OMOs is now much lower, and officially you should not probably budget for any more. And the reason being that the RBI is also reasonably aggressively unwinding its forward short dollar book. So you may recall that at the peak of the aggressive INR defense that RBI had mounted with aggressive dollar sales to defend the INR, they were basically uh, defending the INR through two routes. One was spot dollar sale to the marketplace, and second was forward dollar sale. And the forward up to 1 year maturities short dollar book had actually touched something like 80-85 billion dollars, which they have now cut to around 50-51 billion dollars as of 53 billion dollars as of April end. So whenever RBI tries to unwind its forward short dollar book, that also has liquidity impact, the rupee liquidity impact. So part of these aggressive liquidity interventions, most of it is, like I said, because they don't want any hindrances to broad-based transmission, but part of it also reflects this thing that they need to keep unwinding the forward dollar book. But yes, as of now, the probability of second half OMOs is significantly depleted, and that is what is on market's mind as well. So to recap, three measures today: a more aggressive than expected repo rate cut, a CRR cut which is completely out of the blue, and a change of stance. The first two clearly consistent with what the RBI has been doing so far, which is to ensure that uh, whatever easing is done is as quickly as possible transmitted to the broader economy. And in some sense, they have upfronted the total easing that they wanted to do. and kept liquidity conditions very positive, also given future commitment on liquidity so that nothing comes in the way of transmission. However, the change in stance, like I explained in detail, is quite curious because they are actively working against the forward expectation channel of the market. And you wonder, why they would want to actively do that. Like I explained, it's not as if somebody had very aggressive repo rate cut views from here that they were trying to curtail. Having said all of that, just like the general economy will see transmission over a period of time, we expect the bond market and the yield curve to also continue to see that transmission. And let me explain. So, like I said, one view is that we are pretty much done with repo rates and there are no OMOs happening. So, therefore, steepen the yield curve. The other is, to what extent do you keep steepening the yield curve, after which it starts to make lesser and lesser sense to do that. Or put another way, it automatically starts creating more demand for duration, which is, let's say, 10 year, 15 year, 30 year, etc. Now, first of all, take a step back and see that India has no macroeconomic issues. In fact, it's quite the reverse. It's one of the best run countries from a macroeconomic standpoint. And it's really, an envy of the world on a variety of parameters, including inflation, including the credibility on fiscal deficit, the kind of current account deficits or dynamics that we are experiencing, etc. Now, unlike in the Western world where aggressive curve steepening is happening because of a fundamental issue, which is that they are losing fiscal credibility. So look at the US, for example, where 5 to 30 year spreads have widened very significantly because they are already running a 6.5% budget deficit, and the new bill that is being talked about will probably put further pressure on this fiscal deficit. The reverse, in fact, is true in India, where the government has shown extreme fiscal conservatism and credibility. They have steadily reduced central government deficit from 9.2% of GDP in the year post-COVID to now 4.4% of GDP. And they have laid out a roadmap for you, which is very credible and continues to offer reasonable conservatism as far as deficit is concerned. So in India, the steepening of the yield curve is not a fundamental macro problem. And for that reason, there is only so much that it can run for. Right. So imagine, people come back to the workplace tomorrow, day after, next week, next month, etc. And they say that, we are lending money at 5/4, uh, or we are getting overnight money at 5/4 to 5/2, whereas the 10 year is at 6/4, the 30 year is at 685, 690. And there is no inflation issue, there is no macroeconomic issue, there is no fiscal issue. So this state of an yield curve cannot exist for too long. In fact, probably RBI should already have cause for concern that for an economy that is so well run, where the monetary easing cycle should have persisted for so long, the first day's report card from the market is that many market participants are thinking of this as a flash in the pan, and therefore they don't have enough confidence to be buying duration part of the yield curve. Right. So that is the first red signal that the RBI should already be picking up, but I don't think they'll be picking this up today. The second thing is that the distance between duration to repo, let's say as a working hypothesis, the 10 year to repo, is not just a function of the number of rate cuts, but also, as we very well know, what is the kind of demand getting generated for that part of the curve. Because we have even seen 10 year to repo being at 25, 30 basis points or 50 basis points when the fiscal situation has been well behaved, inflation has been under control, etc. And I see no reason why you should have this steep an yield curve with the kind of macro dynamics India has, which we just went through. There is one other thing that we are looking for from the rest of the world, and that is very, very important. See, sometimes when we think about our bond market, our monetary policy, our demand and supply, we think of it in a very local fashion. But the truth is that we are also impacted, not to a very large extent, but still to a reasonable extent, by what's happening in the rest of the world. Now, as you know, and one of the most notable aspects of global macro since early this year is that the dollar has been depreciating, even as US yields have been volatile, even as the expectation with respect to Fed rate easing is also volatile, and nobody really expects them to ease too much. So there has been a divergence between US yields moving in one direction and US dollar moving in another direction. So yields have been moving higher to flattish, and US dollar has steadily been depreciating. This is something that we have been talking about since last October, November, which is market taking a pause on the so-called US exceptionalism trade, which is to say that over the last 15 years, the financial flows into US dollar assets have been very aggressive, so that most global portfolio managers are extremely overweight US dollar and dollar assets. And finally, they have been given enough reason, some of which are pertaining to the next 3 or 4 years of the cycle, which is reversing of migration, which is some bit of the AI boom sitting outside of the US in other places like China, which is incremental fiscal stimulus not being as strong as it was 3 years back, as well as new developments which is related to policy volatility, so trade tariff volatility and so forth. So all of these are giving reason for many investors to rethink the level of overweight they have to the US, and that overweight on the margin is getting hedged out. So there is not too much sign that actual funds flows are happening out of the US, but there are enough signs that people are hedging those exposures, thereby putting pressure on the US dollar. And because the US exceptionalism trade has run for 15 years, our sense is even a part unwind of that will also run for a few years, and it will not just immediately kind of go away in the next few months. Remember also, there's a difference between people diversifying a bit out of very overweight US dollar positions because they no longer buy into the US exceptionalism trade with the same intensity they had bought into before, and thinking that US is losing reserve currency status. Because many times, when we put forward this argument that US may be experiencing some diversification because of US exceptionalism, the counter given is, but oh, what is the alternate to the US dollar? That's not the point. So we are not saying that US dollar as a reserve currency is under threat. All we are saying, and many people are saying now, is that because over the last 15 years, financial flows have been so overweight US dollar, there is some diversification happening out of it, which is still consistent with US remaining the reserve currency of the world. So what you have seen in the first phase so far is that the dollar has been weakening, but US rates have been still volatile. And therefore, while emerging market flows have started to pick up, India has still not seen any benefit of FPI flows returning in the bond market. We think the next phase that is going to happen is, as US hard data breaks or starts to break, US yields over a period of time will also start to break lower. And therefore, you may get a phase of the market where both US dollar as well as US Treasury yields are falling. And we think over that phase, you will start to get emerging market bond allocations return, including to India. And that also will be an important source of additional duration demand in the marketplace. So the point we are making is that today's price action in the market would have you believe that this rate cycle was only 4 months long and all is done and dusted. And now you are already at terminal repo rate, and therefore it makes no sense to be really actively engaging in the bond market, but for the very front end of the yield curve. We seriously doubt that that is the case. So to summarize, India's own macros do not argue for a very steep yield curve. Fiscal is conservative, RBI policy is credible, current account is 1.5% of GDP, and we are one of the largest markets in the world now. Second, the phase of only US dollar depreciation alongside very volatile US Treasury yields will soon give way, in our view, to dollar depreciation combined with falling US Treasury yields as well. And that we think will also trigger duration demand from offshore flows into large emerging markets like India, which has so far been absent. Now, again, let me make one distinction, because one push back is that at 6.5% US fiscal deficit, how can US bond yields fall? If you think about the logic here is erroneous. Bond yields will not fall as much as they would have fallen had fiscal deficit not been 6.5% in the US. However, they will still fall, reflecting hard data beginning to weaken in the US and the Fed flipping into more rate easing. Now, if you were to consider the Fed for a minute, and you got some clue from the last minutes of the Fed meeting, so there's already a sense that whatever tariff impact on inflation that happens will be more temporary. So transient has become a very dirty word, but it will be probably lasting for the next 6 to 12 months. But the labor market weakness that this triggers will be of a more enduring nature. Because if you think about it, once the uncertainty starts to lead to companies shedding jobs, it almost becomes an self-iterative process. So companies are shedding jobs because they see demand downturn or uncertainty leading to demand downturn. People who have lost jobs unfortunately lose the power to consume, and therefore the demand suffers further, therefore leading companies to shed jobs further. So it kind of becomes an iterative loop which lasts for much longer. So our sense is, as the hard data over a period of time, it won't be one way, but over the next few months starts to show the damage from uncertainty that is already in the marketplace, in the economy, the Fed will also start to step up easing and US bond yields will fall. And that phase, when you have weaker dollar and weaker US treasury yields, is probably going to be great news for emerging market bonds, including emerging market duration bonds. And if the start point is such a steep yield curve, the valuation cushion at duration points is going to be very, very phenomenal. So to summarize, even though today's price action seems to suggest that the market thinks everything is over, this is not a 4-month cycle. In fact, the one kind of error that RBI may have made today, like we discussed with the stance change, is almost showing to the market that we have done everything we can and therefore this is it. Whereas the kind of stable macros and the kind of work that government has done to bring in stability argues for a long period of lower funding costs. And therefore, it was way too premature to change stance to neutral at this juncture, in a very strong view. So as the next 3 months, 6 months, 9 months pass, and people continue to see funding costs at a very low level with hardly any sign of incremental inflation or very strong credit growth getting generated, and let me just address these 2 points also, then people will invariably come back to the marketplace to also own duration points on the curve, and there'll be a lid to the level of steepness that the yield curve can achieve, absent any kind of a fiscal stress which we just don't see. So again, to contrast this to the Western market, the Western markets are facing fiscal lack of credibility, and which is why yield curves are steepening there. India curve is steepening just because of a temporary demand supply imbalance and probably a misstep that RBI made today in changing the stance. Now, let me quickly address this part of the concern that RBI has gone overboard with easing. That's not our view. I'm just saying, this could be one concern, that RBI has gone overboard with easing. Therefore, inflation will pick up, credit growth will pick up, and the time for bonds is over. So let me address that. First of all, we don't think RBI has gone overboard with easing. Again, to summarize and re-emphasize, it's just that they have upfronted the easing they wanted to do to the largest extent so that time is not wasted in transmission. So at 5.5% repo rate, when the average forecasted inflation is 3.7 for this year, by no stretch of the imagination have they overdone it. Much of the growth slowdown is in front of us as far as most of the rest of the world is concerned. And therefore, from that standpoint, also, they have not overdone it. You may argue that they have been very generous with liquidity provisioning, but as I explained, they have also been simultaneously unwinding their short dollar book, and therefore the net effect on liquidity may not be as large as you think. Also, there is a diminishing utility or diminishing marginal utility to liquidity as well. So neither is it generating too much inflation because the demand side is weak, nor is it going to fuel a very aggressive rebound in credit for the same reason, because the demand side of credit is relatively weak. So if you think about credit in two ways or two parts, one is the corporate credit cycle and the other is the retail credit cycle. Now just imagine the kind of global uncertainty that exists today that is coming in the way for a private sector full-fledged corporate capex cycle. So there is the threat of import dumping from countries like China, who can no longer supply to the US the way they used to. So most of your raw materials that China produces, or even semi-finished goods that China produces, you are always under threat that you can get it much cheaper, so why try to produce here? For the finished good marketplace, a similar sort of uncertainty exists. So which market really can you rely upon when the tariff world is still not stabilized? So this is not a very conducive part of the cycle, and largely for global reasons, nothing to do with domestic reasons, because domestic balance sheets are all clean. But this is that part of the cycle where you cannot argue for a broad-based pickup in private sector capex, which is why we don't think there is a broad-based corporate credit cycle that is coming, which leaves the non-corporate cycle, which so the retail credit, the unsecured credit, loan against properties, mortgages, etc. Now that market is already growing very fast. So it's not as if there is a fresh leg up that can really happen in that market, because if you see each one of these sub segments, they're already growing very fast. Most of banks and NBFCs are already focused there. So long story short, we don't think this level of easing and this level of liquidity provisioning is going to generate either inflation threats or an expectation that there is a very material credit cycle rebound that will happen, which will lead to any sort of dent to bond demand in the marketplace. So to summarize and to conclude, most of the actions today, which is the rate cut and the CRR cut, were consistent with RBI's one central motive, which is for transmission of the easing that they have done. We think the change in stance was way too premature because it cuts the expectation channel of easing, and which is a very, very important channel for both, especially the marketplace, but also for the real economy. However, the kind of price action that you have seen today in the marketplace, which seems to suggest that pretty much all is over with this cycle, we completely disagree with that. India has a very strong macro foundation. Fiscal stance is conservative. We think there is a limit to the amount of curve steepening that may happen. Also, because the front end of the SLR curve will soon reach a level where it's just not offering enough value. So let's say the 3-4 year government bonds start to approach 550 560 levels. They are hardly 15 basis points away from there. Most market participants will say there's nothing left over there. So slowly then demand starts to shift towards the mid segment, the long segment, etc. And we think the best global trigger for long bond positions are still ahead of us, which is hard data beginning to break, and the US seeing a period of US treasury yields falling along with US dollar falling, which will bring back duration demand for emerging markets like India. So from a takeaway standpoint, we don't think this is the time to completely collapse your maturity profile. At the same time, in the near term, one cannot deny there is slightly more volatility as market sentiment kind of stabilizes. We also think that there will come a time soon enough where, so for example, in certain fund strategies where you may be running more of 3 4 5 year, it may start to make more sense to slowly move to a combination of just bank CDs and government bonds, because most of the play associated with 3 4 5 years may soon be stabilizing. I won't say over, but stabilizing. So it still remains a very interesting and engaging market. What has worked probably over the last 3 to 4 months, the market, our sense is it may not necessarily work for the next 6 months. At some juncture, as people start to receive the steepness of the curve, we think duration may also start to do better. Obviously, your exposure there should be versus the risk appetite that you have. In intermediate duration products like short term, medium term, corporate bond, banking, PSU, at some juncture, you should look for fund managers to start shifting to a little more barbells, which is, like I said, the immediate front end with some sort of receiving steepness on the yield curve, but that is more the back end of the product.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.